Hello everyone, this is Suslov, Head of Capital Markets at AD Mortgage with our AD Weekly Digest. As always, we're here to shed more light on economic events, mortgages and market forecasts. CPI numbers went out strong and secured 75 basis points hike next FOMC meeting. Some Fed speakers has mentioned closer to 5% Fed funds rate is possible by the end of the year. Aside from hawkish news, I want to remind you AD is planning to launch HELOC product in the coming months. We would advise everyone to review your pipelines for the borrowers whose properties have appreciated in the past year and now they have an opportunity to extract more equity out of their homes. A&D is a strong bid for scratch and dent loans as well. Please make sure to reach out to Billy and share your pipelines. You may find his contact information by clicking on this link attached to this digest. With this being said, turning it to Billy at this moment to get more details on numbers, economic and further expectations.
Hello Alex, hello everyone. The past 2 weeks we've learned two very important things. We've learned that the jobs markets remain stronger than expected. We also learned that CPI remains higher than expected. The Fed is what's driving the markets, CPI is what's driving the Fed, and with jobs remaining strong, then just as you said, Alex, there's little reason to think the Fed will not be going another 75 basis points on November 2nd. That would bring the funds rate to 4%. Even if they only went 50 basis points, there's still the December meeting, so year-end Fed funds are going to be in the fours, likely 4.25 to 4.75. If the Fed truly remains as data dependent as they claim, then it will be 75 basis points in November, and by year end it figures to be 4.50 to 4.75. And yeah, in next year we're going to see a 5% Fed funds handle, almost certainly. The last time we sat down to do a digest, the 5-year yield had been as high as 4.25. It did bounce from there, but now it's been as high as 4.34. Last week, the 10-year had been as high as 3.99, bounced back into the 3.50s. Now it's been as high as 4.08. The 2s and the 3s have both traded through 4.50. So the short end of the curve is still trying to find some support right around projections for where Fed funds will be at year end. But the only positive I can point to regarding the markets is that despite an incredibly ugly CPI report, the high yields of the move, and for years, were made in the first, I'd say in the first hour following CPI, and the markets bounced 20 basis points from there. They did begin to weaken again the next day, but any sort of bounces following that ugly of a CPI report seem to be suggesting that, at least for some traders, yields may have come up too far too fast. I can't imagine that we're looking at any sort of a top right in here right now. But the fact of the matter is that corrections always occur in markets that are trending. These should be no different. We can look for bounces, even if it's hard to pick exactly when they start. So, Alex, with that, I'll kick it back to you.
Billy, thanks for the overview. We're all awaiting next FOMC meeting and PCE numbers in 2 weeks. Next week, Billy and I will be in Nashville for annual MBA conference on October 24 to 25. We'd love to set some time on our calendars or meet at AD Cocktail Party on Monday 24th at 6 p.m. Click on the link at this digest for more details. Make sure to follow us on YouTube channel, like this video and subscribe to Billy's daily market newsletters to stay on top of the capital markets events. Thanks everyone, it was Suslov, Head of Capital Markets at AD Mortgage. Stay tuned.